Okay, let's unpack this. We're looking at healthcare landscape, right? It's being totally reshaped by tech, an aging population, huge cost pressures. And right in the middle, you've got this company, Humana, that's gone all in on government-sponsored care. So the big question is, has Humana placed the perfect bet here, or has it maybe painted itself into a corner? That's what we're going to find out in this deep dive. Today, we're zeroing in on Humana Inc., ticker HUM, a company at, well, a really fascinating crossroads. It's a specialist in a world full of these giant, diversified players. In this deep dive, it's custom tailored for you, drawing out the most important stuff from our analysis. We're anchoring this to September 2025, with a share price of $303.66.
Yeah, and what's really fascinating, I think, is just how deliberate Humana's strategic choices have been. They've literally reshaped their whole business. So our mission here is a fundamental analysis, basically helping you understand the business like a long-term investor would.
Wow.
We're focusing on the underlying operations, its competitive strengths, and ultimately its intrinsic value, and how those big choices might shape its future over the next decade or so.
Okay, so let's start with the core business, because Humana isn't just, an insurer in the traditional sense. It's much more like an integrated care delivery system. And the revenue concentration is pretty stark, isn't it?
Yeah.
Like 91% comes from insurance premiums, mostly government-funded programs, especially Medicare Advantage.
Exactly. A whopping 91%. And it wasn't an accident. Humana made a very, very deliberate strategic choice back in February 2023. They got out of the employer-based commercial group insurance market completely. The whole move was about doubling down on government-sponsored care. So yeah, they've inextricably linked their fortunes to an aging America. It's a bold bet, a very focused bet.
And that bet, that strategy, it's built around creating this virtuous cycle you hear about through their CenterWell segment. Can you break down how that actually works? It's more than just owning different pieces, right?
Precisely. Yeah, think of CenterWell as Humana's provider arm. It's their way of delivering care directly. It includes several key parts. Primary care clinics specifically focused on seniors. Then there's home health services, hugely boosted by that Kindred at-home acquisition they did. And pharmacy solutions, too. So when Humana, the payer, also owns the clinics, the home health, the pharmacy, the actual providers, they get this incredible level of control. They can, guide members towards their own preventative care, manage chronic conditions more proactively, hopefully keep people out of the hospital. It's meant to keep members healthier, which controls costs for Humana. It creates this loop. And a really critical number to watch here is the medical loss ratio, the MLR. That's the chunk of premium money they pay out in claims.
Yeah.
It usually sits around, say, 87% to 90%, which means margins are tight, really tight. Even small shifts in medical costs can have a huge impact on their bottom line.
Okay, so a quick summary of the offerings then. You've got the main engine, Medicare Advantage plans, those all-in-one plans, hospital, medical, drugs, sometimes extras. They also have standalone Part D prescription plans and Medicaid plans in some states. And then sort of holding it all together, you have those CenterWell services, the clinics, home health, pharmacy. All working together.
That's the picture. And market position-wise, Humana really is a titan in its niche. It's one of the biggest MA providers out there. We're talking about 5.9 million individual MA members, roughly 17 million total medical members. It's significant scale. Market cap is around $36.5 billion as of our analysis date. A big company, no doubt, but, and this is important context, you compare that to giants like United Health Group. Their market cap is way, way bigger, and they have Optum, their own integrated arm, so it really highlights Humana's role as this focused specialist, not an everything-to-everyone kind of player.
So what does this actually mean for the patient, for you potentially using these services? Humana's pitch isn't just, hey, cheap insurance. It's more about being a long-term health partner, especially for seniors. The goal is integrated, value-based care, better health outcomes, lower long-term costs. It's supposed to be a win-win, right?
Yeah.
Keep members healthier, keep them out of expensive ERs.
Exactly. And if you do that well, it should improve profitability for the company too. That's the theory. And if we connect this to the wider industry, Humana's got some really powerful tailwinds behind it. The biggest one, no question, is demographics. The aging U.S. population. I mean, the baby boomers hitting retirement age, that's just a massive expanding market for Medicare. It's Humana's core market. Beyond that, you see these broader shifts too. More focus on customer experience, these integrated care models, condition-specific programs, and obviously the acceleration of digital tools, telehealth, AI. Humana's strategy, focusing on value-based care through CenterWell, is theoretically well-positioned for all this if they execute.
Yeah, if they execute. Because despite those tailwinds, the competition is fierce. It's basically an oligopoly, right? Dominated by giants. You've got United Health, Cigna, Centene, Elevance Health. These are massive diversified companies. So Humana, even as a leader in its niche, is constantly battling these formidable rivals. Like you said, UnitedHealth Optum is a direct and much larger competitor to CenterWell. They're fighting for every inch.
And that brings us to the really crucial regulatory piece. For Humana, the Centers for Medicare and Medicaid Services, CMS, they're not just a regulator. They're almost like a business partner. Humana's bottom line is just incredibly sensitive to what CMS decides. Everything from the reimbursement rates they set each year, the complex formulas for risk adjustment, how they pay for sicker patients, and especially that 5-star quality rating system. Getting 4 or more stars triggers significant bonus payments. That's crucial profit for them. So it really raises the question, how much control does Humana actually have over its own fate when these federal decisions are so critical?
That is a huge question, isn't it? If CMS is basically a partner, does Humana truly have an economic moat? Or is it more like a gilded cage? How do they defend against a sudden policy change?
It's a very fair point. Policy risk is always there. But the industry itself does have incredibly high barriers to entry. That does create a kind of moat for established players like Humana.
Absolutely. I mean, just think about starting an insurance company from scratch. The regulations, the licensing, it's a nightmare. Then you need years to build provider networks that people, especially seniors, actually trust. Decades maybe to build real brand loyalty. And just the sheer amount of capital needed to integrate care delivery like CenterWell, it's massive. These things protect the incumbents. Okay, so within that protected space, Humana has some specific advantages. Their brand is a big one. Seniors trust them. Forrester ranked them #1 for customer experience. U.S. News & World Report called them the best overall Medicare Advantage plan company in 2023. That counts for a lot. Then you got economies of scale. 17 million members gives them huge bargaining power with doctors and hospitals for better rates. And switching costs, right. Once you're in the Humana system, MA plan, CenterWell clinic, pharmacy, it's kind of a hassle to leave. You're embedded. But maybe the most unique asset is CenterWell itself. That integrated system, it gives them control over quality and cost that, a pure insurance company just doesn't have. Like their answer to Optum, just more focused.
Right.
So, powerful advantages, clear strategy, who's leading the charge? Let's talk leadership. James Reckton took over as CEO in July 2024 from Bruce Broussard. And what's really interesting, maybe even telling, is Reckton's background. He was president of Optum Care at UnitedHealth Group. Humana's biggest rival. Talk about hiring proven expertise straight from the competition.
It certainly signals a deep commitment to making that integrated care strategy work. It's a big statement. Now, on the ethics front, Humana talks a good game with their Ethics Everyday code. Publicly, that's the message. But we do need to acknowledge some, let's say, complications, history, and ongoing stuff. There was that $90 million settlement in August 2024 over allegations of fraudulent Medicare Part D bids going back to 2011-2017. And maybe more relevant right now, they're facing a class action lawsuit. This alleges they improperly used an AI model to just systematically deny claims for post-acute care.
That's the one grabbing headlines, isn't it? An AI denying claims. So you've got ethics every day on one hand, but then these incidents, especially something as sensitive as AI making decisions about patient care denials. How does that square up? And what does it do to trust?
It definitely raises some tough questions. Questions about how those stated ethics actually play out in practice, particularly where tech meets patient care. The lawsuit claims this AI predicted care needs, leading to denials even when doctors thought patients needed more time. That creates real tension with the whole long-term health partner idea. Managing this perception and the actual outcome of the suit will be a major test for the new CEO, for sure.
Okay, switching gears to capital allocation. Their strategy seems pretty clear. Reinvest in Medicaid and especially CenterWell. They see those as the highest yield opportunities. We saw the big moves like buying Kindred's home health business that was foundational for CenterWell. Then, smartly perhaps, they sold off a majority stake in 2022 to de-risk a bit. They've also shed other non-core things like Concentra and, of course, made that huge exit from the commercial group market. We should probably remember the failed Aetna merger attempt way back in 2015-2017. Antitrust killed it, but it kind of cemented Humana's path as this standalone specialist. And shareholder returns. They've been paying a consistent quarterly dividend for, 14 years now?
Yeah, 14 years.
Annualized at $3.54, and the payout ratio is low, like 27.1%. Seems sustainable. They do some share buybacks, but it was pretty modest in Q2 2025, only $100 million. No big plans for more this year. It really signals they're putting reinvestment first, basically saying putting cash into CenterWell is a better bet than buying back our stock right now.
Looking at the financial health overall, revenue growth has been impressive. A 12.6% compound annual growth rate from 2019 to 2024. That's strong. But, and here's the contrast, profit margins are thin. And volatile. Net profit margin is just 1.28% trailing 12 months, and net income dropped sharply over 50% in 2024, mostly because medical costs went up. That volatility, that thinness, it goes straight back to that MLR we talked about. Small cost increases can really hurt profits. Free cash flow, it's been robust but also jumpy, $2.44 billion TTM, but that's down from a peak near $4.3 billion back in 2020. Debt looks okay, moderate debt to equity at 0.71, strong coverage ratios. Liquidity is good too, current ratio of 1.95, but return on invested capital, ROIC, that's key. How well are they actually making money from all the capital poured into CenterWell? It's 7.69% TTM, but historically, that number's been all over the place. That highlights a huge challenge for the new management. Prove they can consistently generate better returns from these big long-term bets.
Okay, valuation. This is interesting. Humana's trailing PE ratio is 23.29. That's actually higher than its own 5-year average, which was around 20. But here's where it gets really interesting for you as a potential investor. Compare that 23.29 to the competition. UnitedHealth is around 13, Cigna 16, Centene way down at 7, Elevance Health about 13.5. So Humana has this significant valuation premium. What does that tell us?
It tells us the market is pricing in a lot of optimism, maybe too much.
Right. It suggests the market isn't just hopeful, it's almost demanding perfect execution from Humana, especially on that CenterWell strategy. If there's any slip-up with those thin margins or regulatory issues, the market might react pretty harshly. High stakes.
Yeah, market sentiment reflects that caution. It's kind of mixed. Wall Street consensus from 20-something analysts is basically hold. And their average 12-month price target around $281, $288. That's actually below the current share price we're using. Media coverage is mixed too. You see headlines about good Q2 earnings beats, raised guidance, but then also about the stars missed not getting enough high star ratings and those margin pressures. Technically, though, it's a bit different. Short interest is meaningful at 4.39%, showing some bearish bets, but it's less than some peers. But the stock itself is trading strongly above its 50-day and 200-day moving averages. So strong, bullish, technical momentum, it creates this weird tension, right? Cautious fundamentals versus strong technical.
And ownership. It's almost all institutional, like 95.5%. The big
Sure.
names, Vanguard, Dodge & Cox, BlackRock. Insider ownership is pretty low, 0.1, 0.2%. Typical for a big company. And this is important. I think there's been recent net buying by insiders, about 85,000 shares over the last 12 months, including the new CEO buying shares.
That's usually seen as a positive signal, just confidence from the inside. Okay, let's talk risks. Connecting back to the big picture. Humana's biggest weakness, its biggest threat, really, is that heavy dependence on government programs and just how incredibly sensitive they are to CMS decisions. Reimbursement rates, risk adjustment rules, those star ratings, even a small tweak in policy from Washington can have a massive impact on their profitability. It's a constant vulnerability. Then you add intense competition, those persistently high medical cost trends squeezing margins. Now, an external factor, geopolitics, like those proposed U.S. tariffs for 2025 on medical devices, IT hardware, pharmaceuticals. If those happen, it could significantly bump up claims costs for everyone, including Humana. Just another layer of cost uncertainty.
Okay, so let's try to wrap this up. The bull case for Humana, what is it? You've got a market leader riding this huge demographic wave of aging Americans. They're building a moat with CenterWell, that integrated strategy. New leadership seems strategically focused, maybe bringing fresh discipline. You've got insider confidence signaled by buying, and a reliable dividend.
Yeah.
That's the positive story.
Right. And the bear case, it starts with that extreme concentration risk in government programs, all the regulatory sensitivity. Then there's that significant valuation premium compared to peers, less room for error, more potential downside. They're dealing with severe margin compression from rising costs. And you have those ongoing legal and regulatory headaches, like the AI claims denial lawsuit.
And just to reiterate, our educational DCF model, for what it's worth, generated an estimated intrinsic value range of roughly $290 to $330 per share.
So what does this all mean for you, thinking about this company?
Well, at its current price of $303.66, Humana lands smack in the middle of that estimated value range. It suggests the market might be, fairly balancing the big long-term opportunities against some very real near-term headwinds and risks. Based on our model, it doesn't scream bargain with a huge margin of safety, but it also doesn't look wildly overvalued compared to its potential to generate cash.
So here's a final thought for you to chew on. As you consider Humana's journey, which story wins out? Is it the specialized pioneer, perfectly positioned for demographic growth? Or is it the highly regulated company, squeezed by costs, facing legal scrutiny? Which narrative do you think shapes its next decade? And the standard disclaimer. This deep dive was generated by an AI system for educational purposes only. It should definitely not be considered financial advice. Please Always do your own research or talk to a qualified financial advisor before making any investment decisions.